Welcome to the weekend edition of the Fear and Greed Business Headlines, the week that was, a wrap of the biggest stories over the past week. I'm Sean Aylmer. It was a week of COVID outbreaks, corporate takeovers, financial market jitters, and some pretty left-field ideas from big businesses. Let's start with financial markets. The big news was that cryptocurrencies didn't dominate discussions. As normal, cryptos went up and down more than other asset classes, but were somewhat more orderly than last week. That's a good thing because the movements in digital currencies were starting to impact bonds, equities, and the gold market. Those more mature markets, shall we say, work much better without the skittish behaviour from those young assets like cryptos. The local share market had a down and up kind of week, though by Friday the S&P ASX 200 hit a new record high. The local market is one of the gun economies in the developed world, thanks largely to commodities, and that has stood the bourse in good stead. Commonwealth Bank, the market leader, went through $100 a share for the first time this week. The other banks also did well. It was a bumpier ride for the big miners. BHP, Rio Tinto and Fortescue were sold off after Chinese authorities said they had zero tolerance for monopolies in spot and futures markets, the spreading of false information, price speculation and hoarding. That sent the price of iron ore much lower and the big miners followed. But by the end of the week, they'd regained most of their mojo. It was a week in which the head of the $179 billion future fund said the best might be over for investors. Raphael Arndt warned that inflation was a risk to financial markets and rising interest rates would make it more difficult to generate returns. The days of easy returns could be over because the trillions of dollars of stimulus from governments was coming to an end. It was a fairly sedate week on Wall Street and in European markets. The debate about how much inflation is in the system continues to dominate investor discussions. Those that think there isn't too much price pressure believe central banks around the world won't lift interest rates. That means the spend fest will continue, and that's good for equities. But those that are worried about inflation are less positive. This week, the Central Bank of Canada and the Reserve Bank of New Zealand, as well as a couple of Federal Reserve officials, hinted, sort of, that monetary policy might tighten in those countries. Both oil and gold prices had a decent week, with Brent crude heading towards $70 a barrel and gold touching just above $1,900 an ounce. The Aussie dollar, well, it did nothing, trading around 77.5 US cents all week. In the economics world, the Australian Bureau of Statistics released data showing that capital spending surged last quarter. That is great news because the economy needs business to keep investing, to keep turning things over. Australia also recorded its third largest monthly trade surplus of $10 billion last month, thanks to falling imports and higher commodity prices. Total exports in April hit a record $36 billion. But there was also a sense this week that maybe the best was over for the commodity cycle as China tries to rein in those prices. Official economic growth figures are due for release next week. There was plenty of international news around this week. The G7, that's the world's 7 largest advanced economies, have agreed to stop international financing of coal projects that emit carbon by the end of this year and will phase out support for all fossil fuels to meet globally agreed climate change targets. Australia is looking a bit like a spare wheel on this one. The G7 also seems close to an accord on corporate taxation of multinationals. Any global deal would pave the way for new levies on the world's largest companies. Under a deal, global corporations, including the tech giants, will have to pay a proportionate amount of tax in the country to where sales are made. If adopted, it would mean that tech companies would pay much more tax in Australia, but potentially the local miners would pay much less. While the rollout of COVID-19 vaccine continues, there's still around 600,000 new cases being reported around the globe each day. The numbers in the United States are falling, whereas in parts of Europe, notably Germany and the UK, there are concerns that the growing confidence about the future might be somewhat misplaced. It was even reported that at least 100 people on Mount Everest have the infection. The different levels of success in containing the virus were stark this week when the US announced it had inoculated half its population with at least one jab and was reporting about 30,000 new cases each day. In contrast, India said its daily infection rate was 200,000 and the vaccination rollout was poor. President Joe Biden ordered US intelligence authorities to redouble their efforts to find the origins of the coronavirus after conflicting theories about whether it started naturally or in a lab. He called on China to allow access to all relevant data and evidence. You can imagine how happy Beijing was. Britain and Australia edged closer to a free trade deal. Agriculture remains the sticking point, and it may take local farmers 15 years before they get full access to the UK market. This is a big deal for Westminster. It will be the first free trade deal since Brexit. For Australians, we get access to cheaper whiskey, cars, all sorts of goods. The final deal will hopefully be announced next month. On to local news. A Senate report into the Australia Post Cartier watch scandal said the Morrison government should apologise to former Chief Executive Christine Holgate, and Board Chair Lucio Di Bartolomeo should resign. The Senate inquiry occurred after Ms Holgate was sharply rebuked by the Prime Minister for giving 4 Cartier watches to senior Aussie Post managers as bonuses last year. A review by Scott Morrison's Chief of Staff cleared members of the PM's media team over allegations they briefed journalists in a detrimental manner about Brittany Higgins and her partner. Ms Higgins alleged she was raped in an office in Parliament House in Canberra, and there's been much debate about how she's been treated since making the claims. The report found there was lots of chat about the allegations, but no negative briefings to media. It was a tough week for the Leader of the Opposition in New South Wales, Labor's Jodie McKay. Last weekend, the incumbent Nationals won the Upper Hunter by-election, and the opposition experienced an 8% swing against it. Very unusual in a by-election for the alternate member to do so badly. That put pressure on Miss McKay, which increased after front benches, including the state's shadow Treasury spokesperson, resigned. That was pretty much the end of it, and on Friday, Ms McKay resigned as well. There was plenty of corporate news around this week. Ramsay Healthcare will buy British company Spire Healthcare Group in a $3.7 billion deal, which includes a chunk of debt. Australia's largest private hospital operator will become Britain's leading private healthcare provider. Private equity giant KKR and online property group Domain Holdings have made a $2.5 billion bid for property exchange platform PEXA. BetMakers launched a bid for Tabcorp's wagering and media business worth $4 billion. There's already a $4 billion bid on the table from private equity group Apollo Global Management, but that one includes Tabcorp's gaming division. And homegrown electric vehicle fast charger, Tritium, will list on the Nasdaq with a market cap of around $2.2 billion and $390 million on its balance sheet. The high-tech startup, which is just 6 years old, wants to tap into the accelerating electric car growth across Europe and North America. The corporate regulator commenced civil proceedings against 5 companies that were, or are, parts of AMP, alleging that they charged life insurance premiums and advice fees to more than 2,000 customers, even though they'd been told they were dead. There were some really novel ideas from big business this week. That's probably the best way to put it. Shopping centre giant Mirvac launched a strategy to embrace what it calls new retail, offering flexible rents and short leases to lure online retailers into its shopping centres. The idea is that omni-channel retailers can set up in a shopping centre on a short-term basis and get the exposure to customers that comes with that. Qantas said it was considering giving away frequent flyer points and travel vouchers to people who receive COVID-19 vaccinations. Few companies have more of a vested interest in ending the pandemic than Qantas, and loyalty points and free travel could be a way of encouraging people to get inoculated. Commonwealth Bank doubled down in the world of apps and has invested in electricity startup Amber, which provides access to wholesale electricity prices. The idea is that customers will check the app, work out when prices are lowest, and increase the use of electricity at those times. CommBank wants other tie-ups with utility providers as well, and its own app will allow people to check information about accounts they have at other banks. It's all about attracting younger customers. One of last year's market darlings, Kogan.com, had a crazy time. A week ago, Kogan said it had miscalculated inventories, was having problems with its supply chain, and its growth rate wasn't what it was last year. Investors dumped the stock, down 14% in one session. Then they started buying it, and it's regained all those losses. Pepper Money hit the bourse this week in one of the year's most anticipated floats. It was somewhat underwhelming, with shares in the group ending at $2.61 on the first day, down from their listing price of $2.89. It kept falling, and by the end of the week was down more than 15%. And finally, the Financial Review's annual rich list came out. Iron ore magnate Gina Rinehart was number one again, worth $31 billion, followed by fellow miner Andrew Forrest, worth $27 billion. Atlassian founders Mike Cannon-Brookes and Scott Farquhar, as well as Box Kings Anthony Pratt and family, all came in at $20 billion. Now I get to the point in the program where I go through the biggest story of the week, the sleeper story, the most remarkable story, and my favourite story. No prizes for guessing the biggest story of the week, the outbreak of community-transmitted cases of COVID-19 that sent Melbourne into lockdown dominated the news agenda. With restrictions on movements, crowds and business operations, Melbourne felt a lot like 2020 again. The vaccination pace is picking up with around 100,000 people receiving jabs each day. Surely the answer is now clear. Get a jab. The most remarkable story this week involved a power outage in southeast Queensland. It sent 500,000 homes into the dark and was caused by a fire in a generator in central Queensland. The most amazing and instructive thing about it is what happened to wholesale energy prices when it occurred. Wholesale prices in Queensland spiked to above $2,500 a megawatt hour. In New South Wales, the price at the same time was $18.56. It highlights uncertainty in power pricing, and that will be an increasing focus as the economy shifts from fossil fuels to alternate energies. The sleeper story was 3 stories in one, and they all happened overnight on Wednesday. Shareholders in ExxonMobil voted to change the oil giant's board, arguing the oil and gas group's focus on fossil fuels put it at existential risk. A court in the Netherlands ordered Royal Dutch Shell, Europe's largest producer, to cut emissions. And shareholders in Chevron, the second biggest oil company in the US behind ExxonMobil, won a resolution calling for the company to cut pollution. For big oil, this was a red letter week. For the rest of us, this is a big deal because the companies producing huge amounts of raw materials for energy have to change the way they do business. Eventually, that will affect all of us. And my favourite story this week involved the Magic Millions National Broodmare Sale. 900 thoroughbreds were offered, and on day one, the top price went to a multi-Group 1 winning mare. Group 1s are where the best horses run. Funny thing is, I had a bet on this exact horse, called Melody Bell, last Saturday. It did nothing, and days later, it was up for sale, never to run again. Well, isn't that a lesson for me and my gambling? And that's everything you need to know from the last week. I'm Aylmer. I'll be back on Monday morning with the Fear and Greed business headlines. I look forward to your company then.